Good morning from our global headquarters in New York. I'm Manny Scrani alongside Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
A record wipeout, global stocks tumble, Nvidia races $279 billion, now a DOJ subpoena. Under pressure, oil extends its decline, fragile demand and restored supply wipe out all of this year's gains. And Jolt set to kick off this week's run of jobs data, leading all up to payrolls Friday. Good morning, Manus.
Danny, good morning. It's almost deja vu from the start of August. You're looking at a collapse, the worst start to the Nasdaq trading since 2002. It definitely is a redux, and it has that sense of peak panic mode. Just look at Nvidia. It's down another 2% at the moment. It's a crushing blow, down $279 billion and change yesterday. What is it that really sparked that sell-off? Is it a spook about the AI conversion into money? We'll talk about that with Dan Ives a little bit later on. And then a 1-2 punch after the close, the DOJ delivers a subpoena, again, escalating the antitrust issues around that. So it was a classic risk-off mode in equities. Money was driven into the bond market. So the risk bears were emboldened and the bond bulls were also emboldened as well. By the way, the Atlanta Fed comes in at just over 2%, down from 2.5%. We'll debate the growth numbers. And oil cascades low. We are in peak panic mode, really, one could say, in the equity and in the global growth story. Danny, good morning.
Good morning, Manus. I do think it's an interesting debate to ask, why did that sell-off even happen? It had some of the maybe echoes of August 5th, where you had a weak ISM really kickstarting things. But it's hard to argue that a weak ISM is worth Nvidia dropping some 9%, considering Nvidia isn't even a manufacturer. Maybe it is just the vibes of September.
It is. I mean, we debated this from when we got here this morning as to what is it that can constitute a near 10% drop in Nvidia. Is it that we need to seriously review the outlook for AI? Either way, I think what it is more of a panic escalation. We're going to get jolts today, a panic escalation towards Friday, which will perhaps change the narrative about whether it's 25 basis points or 50 basis points. And maybe you do need 50 basis points to continue the growth trajectory for equities. Well, maybe.
It is certainly a scared market, a fragile market. If you have something like Nvidia moving nearly $300 billion in one day, it is extending its decline pre-market, as Manus mentioned, down some 1%. So first we get the panic of yesterday, the everything sell-off. You add a little bit of it today, this DOJ subpoena in an antitrust probe. Let's get over to Bloomberg's Tom McKenzie on it. Tom, just give us the details of this probe.
Yeah, look, as you were outlining there, then a double punch for Nvidia with the market moves that we saw yesterday as well. Part of that arguably fueled by some analyst calls from JP Morgan and BlackRock around how long it's going to take to get that return on investment around generative AI. And then the reporting from the team at Bloomberg in San Francisco around this DOJ probe. They've been sending in questionnaires to Nvidia. Now they've been sending in these legally binding requests, these subpoenas for information. Nvidia has to hand this information over. And what it signals is that the DOJ are one step closer to a formal probe and investigation of Nvidia. Concerns amongst antitrust regulators then in the US at the Department of Justice that the clout that Nvidia has within the artificial Gen AI space is too significant, that they have a grip on this market, that it isn't allowing some of their customers to have the ability to switch up and look at some of the competitors. Nvidia, of course, pushing back on this, saying the reason we are so successful is simply because our products are so much better and because our services are so much better. But you expect this, of course, to unfold in the weeks and months ahead. This could be a long, drawn-out process, but as you say, it's another headwind, at least for now, for this stock.
No irony then, Tom. You know, the moat, the whole defense around Nvidia is supposed to be the unique product proposition, and you pay to play with uniqueness. We've got breaking news on Intel. It was just a few weeks ago that the president, along with Pat Gelsinger, was ringing the bell in terms of money for Intel. This morning, breaking news, of course, that because of the strategy potential change at Intel, that may throw some of this funding into question.
Yeah, look, the timing of this is pretty fascinating, isn't it? As you look at what's happening with Nvidia and the DOJ probe there, and then Intel, which just a few months ago, of course, the CEO, Pat Gelsinger, had been on the ground at one of their factory build-outs with the President Biden, of course, announcing almost $20 billion in incentives. They have not yet received that cash because, of course, the government isn't handing over this CHIPS Act money like candy to children. They want to make sure that these companies involved in the chip space are actually meeting milestones, that they have the due diligence in place. And so far, Intel hasn't met those metrics needed to release that funding. It's leading to tension between Intel and between the government. But just for the outline, for the top line view, Intel is absolutely central to this industrial policy of the Biden administration to get, for example, a flow of chips, reliable flow of chips to the Pentagon, to get the US in place by 2030 to producing about a fifth of the world's advanced processors. Intel is central to that plan so far because of the cash burn, because of the fact the stock is down around 50% year to date, because of the fact they haven't been selling nearly as many chips as many had expected, and the cost of the build out of these factories everywhere from Ohio to Oregon. It is really now a big question mark around Intel and whether or not it can get this cash and the funding, these incentives from that CHIPS Act.
Tom, thank you very much. Tom McKenzie there with the very latest on the tech stocks. Stay tuned. We have a conversation, Danny and myself, on Nvidia and the tech right with Dan Ives from Wedbush Securities a little bit later this hour. Other headlines crossing on the Bloomberg terminal at the moment is on VW. They say that its manufacturing output in Europe is over capacity by 500,000 cars, amounting to 2 plants worth of production. The German automaker also sees industry demand in Europe below its peak by 2 million cars. For more, let's get to our German bureau chief, Christoph Rout. Christoph, good to have you with us on this story. So the VW executives are having a closed-door meeting, as we understand it. These headlines are coming from that meeting. It's quite a serious picture in terms of the demand and overcapacity.
Yes, absolutely. You're right. This is definitely a pretty dramatic development. The meeting that you just mentioned is still ongoing. We got a readout from people in the room basically suggesting that the top labor representative from Volkswagen, Works Council Chief Daniela Cavado, launched some pretty harsh attacks on the management board, basically accusing them that they didn't do their job properly, and that this contributed in no small degree also to the currently really difficult situation. At the same time, the management board responded and basically mapped out what you just flagged in terms of the sort of persistent issue of overcapacity, which amounts to 2 factories in Europe, which is obviously quite dramatic, really.
Christoph, to what degree is this a VW problem? Is it mismanagement from VW versus all European car makers dealing with things like changing to EVs and competition from China?
I think it's a combination, really. It's to some degree, I think the argument is fair to say that the European car market did not rebound after the pandemic to the degree and to the volumes that we've seen before. At the same time, there are also some structural issues that are very Volkswagen specific, essentially. It has been for many years a big concern among investors that the structural inefficiencies, high costs, poor efficiencies have not really been addressed. So in terms of profitability, the core Volkswagen brand, the domestic operations are still lagging behind rivals like Stellantis and others. And at the same time, as you mentioned, the competition is also intensifying because we've seen many Chinese manufacturers pushing into the European market with electric cars for very competitive prices, and that's sort of adding additional pressure on Volkswagen as a company and the industry as a whole.
Do you think these lines add to Oliver Bloom's argument about closures in Germany?
It's really difficult to tell at the current point in time. At some point, there will be, or there has to be, I guess, a situation where management and the unions come to some sort of compromise and a joint solution to all this. The labor unions at Volkswagen, they can block important company decisions like factory closures. And yeah, this is going to be, I think, a pretty few intense weeks, if not months, before they can actually resolve that and then agree, ideally, on a joint way forward.
Hey, Christoph, we really appreciate it. A lot of breaking news to get through this morning. Bloomberg's Christoph Rout. Now let's get to some of the other top stories that are trending on the terminal this morning. And the big airlines in Asia are undertaking checks of their Airbus A350s. Just to remind you, earlier this week, Cathay Pacific discovered an engine component issue mid-flight on theirs. So far, no other carriers have publicly said that they found issues, but Singapore Air said it would inspect all engines. Air China, for their part, canceled 4 domestic flights scheduled today.
Nvidia CEO Jensen Huang's wealth slumped by about $10 billion to just shy of $95 billion on Tuesday. The drop was the biggest single-day dollar drop for him since 2016. The losses come after a rout in the chip stocks and a report that the U.S. Justice Department has subpoenaed Nvidia as part of an antitrust probe.
Tiniest violin. Okay, Elon Musk's satellite internet provider Starlink has reversed course. It said it would comply with an order by Brazil's top court to block access to X. Previously, it had told the country's telecom watchdog that it wouldn't comply, according to the agency.
Coming up, we'll drumbeat to the JOLTS data with Paul Donovan from UBS. That's next.
And we're going to have more on the tech route. We'll speak with Keith Lerner of Truist and Dan Ives of Wedbush all this hour.
It's Bloomberg Brief. I'm Manus Granny alongside Danny Berger in New York. We're counting down to the first jobs data in the jigsaw this week. The JOLTS, the job openings at 10 a.m. Eastern. That's after the manufacturing PMI data fell for a 5th straight month. That was yesterday. Joining us now is UBS Chief Economist Paul Donovan. Paul, good to see you this morning. Thanks for joining us both. One could say this economy in the United States of America, it is not falling off a cliff, but there's a very outsized attribution to yesterday's market action on slightly weaker manufacturing data. State of play for you in USA Inc. Good morning.
Morning. Well, look, the U.S. is clearly on course for a soft economic landing. Growth will be at a bit below trend. We're not seeing significant increases in fear of unemployment or levels of unemployment. Consumers are still spending. You should never, ever bet against the U.S. consumer. It's okay, basically. And this looks like more or less a soft landing. Yes, the Fed is late in cutting rates, but it's not desperately late. It's not done serious damage, just moderate damage. We're okay, basically, in the United States, I think.
And Paul, you write about this idea this morning that the Fed doesn't need to be concerned with financial market moves. It's this idea that we often think we're more important than we actually are in dictating policy. But I can't help but wonder, Paul, if it wasn't for the tremors of last month and maybe even what we're starting to see this week, would the Fed really be considering 50 basis points?
I'm not sure how actively the Fed is considering 50, to be honest. I think that they're probably going to go for sort of a steady pace of easing at around 25. And remember, the Fed is late. Powell has made a series of policy errors over the course of the last 2 years in particular, and they should have been cutting back in May. So the idea that perhaps they go with a bit of a bang at the start, they recognize that, yes, we got it badly wrong on inflation. We should have been following inflation down earlier. Absolutely, that's all fine. But I don't think that that's necessarily the market reaction that is provoking that, because, of course, the market's been bouncing around all over the place, and the Fed has sort of fairly consistently now been signaling the September rate cut coming. So I don't think it's necessarily in response to financial market moves.
Do you think the adjudication of whether it's 25 or 50 basis points in September is solely down to the jobs data on Friday? Adam Posen said in a podcast recently, the labour market is first among equals, but there are other things.
I think the jobs data is going to have probably an outsized influence. Of course, this is where economists get quite nervous. I'm talking about proper economists, not people like Powell, where the reliability of the jobs data has deteriorated noticeably in recent years. So the idea that the decision about whether to go 25 or 50 basis points in September based off a single jobs report, which is going to be revised massively over the coming months, that makes me a little bit nervous. What we really need, and it's too late for this now, what we really need is Powell to have set out a policy framework, a medium-term strategy for how the Fed is thinking about the economy, and then we wouldn't be dependent on single data items. But because we've had this nonsense mantra of data dependency at a time when data reliability is falling, it means that we have outsized influence to single numbers. So I think, in an ideal world where economists were running the Fed, we wouldn't be dependent on a single employment report. In the Powell Fed, we probably are.
Yeah, I mean, look, it's a criticism we've heard before, right, Paul, that Powell comes from a background of law, not necessarily economics, and you're talking about what they should do, not what they will do. So in a world of what they will do, what constitutes a bad jobs number on Friday that seriously puts into contention 50 basis points?
I think for that, it would probably have to be the unemployment rate. And I think there will be some attempt to look at the detail of that. So if it's unemployment because you're getting increased participation in the labor force, in other words, people aren't actually losing their jobs, you're just getting more people coming in, that is something to downplay. But if unemployment goes up because people are actually losing their jobs, then that's going to be a more serious consideration, I think. Now, why focus on the unemployment rate? Why focus on people losing their jobs? Because that creates the risk of a fear of unemployment. And it's the fear of unemployment that does most damage to consumer spending, consumer confidence, and so on and so forth. So that's where I would have my focus. Payrolls, yes, but we've just had big revisions to the payrolls numbers. I'm less focused on the payroll side of things. I think it's more about the unemployment and the fear of unemployment that's going to be driving that decision from the Fed.
Typically, how much distance do we have between fear of unemployment and a negative feedback loop on consumption?
Well, I think at this stage of the cycle, you've got probably quite a short a gap between the two. If you're at different stages of the cycle, it can be quite a long gap. But what we've got to remember here, of course, is that in the United States, until fairly recently, savings rates were coming down. Now, middle-income households still have a stock of savings, but the point about fear of unemployment is you start to question, do we have enough money to deal with the contingency of losing a job? Is that something that is sufficient, or do we need to add to the stockpile of savings? And of course, if you're adding to the stockpile of savings, you're not buying Taylor Swift concert tickets. And that, of course, then constitutes a consumer crisis in the United States. Now, we also have to bear in mind that there have been some other shifts going on in the labor market. So in particular, for example, women are getting better paid jobs, and this is a result of flexible working. So that's some reassurance of a household income. That's a mitigating factor. We've seen people taking multiple jobs. You've got people with side hustles, selling on eBay, and so on and so forth. So there are mitigating factors this time, which sort of complicate it. But I think that a genuine fear of unemployment from middle-income consumers would translate through into spending more rapidly this time.
I really think we need a new measure that helps account for side hustles. Paul, we really appreciate your time this morning. It's always very interesting to hear your take. Paul Donovan from UBS. Okay, coming up, a look at what else is making headlines around the world. There's that also includes a shakeup happening at the top of Ukraine's government in a precarious moment of the war. That to come on your brief. It's Bloomberg Brief. Danny Berger and Manus Cranny in New York. Let's get you some front page news, a look at what's making headlines around the world. And we start with the FT. More issues for getting more home supply on the market. U.S. home builders are facing a credit crunch. Banks are cutting lending. Banks saw the largest year-over-year drop of loans outstanding to fund construction in over a decade. Just to give you the exact figures, $92 billion at the end of June is what loans totaled. That's down from $102 billion a year ago, man.
Yeah, let's keep an eye on that housing market. It is part of the policy mix from the various politicians. Next up, New York Times. It leads with Ukraine's foreign minister offers to resign. Now, this as Zelensky plans a major shakeup. At least 6 cabinet ministers have resigned in the past 2 days, and a new list of ministers to be presented tomorrow.
And meanwhile, we're getting more outlines, more contours of a potential Harris presidency business plan. Harris to expand small business tax relief to boost startups. We have this on the Bloomberg. The Democratic Democratic candidate is said to be proposing a tenfold increase in deduction for startup costs, so from $5,000 to $50,000, and tax is so part of the conversation, Manus, because those tax cuts are slated to expire in 2025, the Trump-era tax cuts.
I mean, that's a heck of a ramp up. It costs about $40,000. I think in the article it says about $40,000 to set up a small business. And what you got here, she's going to set a new goal, which is to get 25 million small business applications in, even though under the Biden administration you have had 90 million and a pretty good record. So this is about grossing up small business America.
Well, big picture, it leads to this question: which party is the business-friendly party? And I think there's a lot of confusion on this. Sure, Harris wants a higher corporate tax rate, but you have things like this of reduced taxes for small companies. And on the other side of things, you have the Republicans, a typically pro-business type of government, wanting more tariffs, and a VP candidate who likes more regulation for companies. So you get this confused picture of who is the pro-business party.
Well, I think what she's going to do in New Hampshire today is try and sort of set that stall out and progress on from the housing, from the groceries, from the childcare, and sort of extend the narrative forward. And that takes us back to the Goldman Sachs narrative. We'll talk about this a little bit later on, which is, you know, if you get a Trump or a Harris administration, what's it going to do for actual growth in this country? And that is a huge debate from what you previously thought under a Republican administration. We'll talk about that before the end of the show.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger, alongside Manus Cranny. Let's set your agenda.
A record wipeout. Global stocks tumble. Nvidia erases $279 billion. Now it faces a DOJ subpoena. Under pressure, oil extends its decline, fragile demand and restored supply wipe out all of this year's gains. And JOLTS set to kick off this week's run of jobs data, leading to payrolls Friday. Danny, good morning. These markets are nervous and perhaps a touch of deja vu.
Yeah, what a strange market when you can get ISM manufacturing, when you get manufacturing that counts for a tenth of GDP, setting off a chain of events that eventually sees the biggest wipeout for a single stock on record. 279, you mentioned this number, Manus, billion wiped out from Nvidia in a single day. Nvidia is not in manufacturing. Maybe it is the seasonality concerns. Maybe it is oil. Maybe it is simple and plain just vibes heading into the jobs report. We fall about 1/3% this morning. Nvidia down, you can see there, about 1% pre-market. It now has a subpoena to deal with from the DOJ. Meanwhile, U.S. two-year yields, they continue to fall another 2 basis points this morning. Your two-year yield yesterday closed at the lowest level since the regional banking concerns of 2023. We are now pricing in more than 100 basis points for the totality of the year from the Fed. Meanwhile, NYMEX crude attempts to make a comeback. It fell some 2% yesterday, maybe a little bit more than that. Concerns about demand, concerns about China. And again, Manus, maybe that fed into the overall concerns about yesterday, or maybe it was just because we rallied on Friday and today, and this week is a big week and we're just nervous and decided to sell everything.
Yeah, exactly. A few more sellers rather than buyers. I mean, the really, really technical approach. But it did have a sense of peak panic when you saw that nearly $300 billion wiped off the value of Nvidia. And I think this brings the much broader debate, is how much farther and further can equity markets run higher here in the US with a muddling through, let's say a muddling through, I think that's what Neil Dudder called it, and muddling through policy response from the Fed, which is, you know, incremental, sort of like piecemeal 25 basis points. You know what? Look large, lump up, look large, do it hard, do it heavy, front load it, get it out there, 50 basis points. And that perhaps can underpin the equity market.
Or does it do the opposite? Because this is one argument out there. If you go 50 basis points, it signals that the Fed thinks something is wrong and that they need that kind of support. And this is an equity market that has switched to bad news being bad news. So 50 basis points could spook markets.
Yeah, then you listen to Paul Donovan, of course, who was scathing. It would be an understatement in terms of the Powell policy response process mechanism and timing. I mean, he was visceral in terms of Powell's being behind the curve.
I think he mentioned Powell's not an economist maybe 2 times in the span of a minute.
It was a tough recap, gotta say.
Well, in yesterday's sell-off, as we said, it was a lot of tech stocks. The semiconductor index had its worst day since 2020. Of course, into that, it's been a pretty interesting year from tech stocks. We are now down just 8% from the July peak. Here's what Keith Lerner of Truist had to say. He writes, after downgrading the technology sector prior to the July swoon, we moved the sector back to overweight last week as we see a better risk reward relative to other areas of the market. And Keith joins us now, the Co-CIO and Chief Market Strategist at Truist. So Keith, you got that August call right. You went back to overweight after that sell-off. So did you want to buy yesterday's dip?
Yeah, well, first, great to be with you. I think time frames matter. So if you have, let's say, a 6 to 12 month time frame, the answer is yes for tech. As we look at the big picture, first of all, I called a lot of my context news. There wasn't anything specific during the day that we could really point our fingers to for why tech was down so hard. Besides people coming back from the Labor Day weekend and really reassessing their earnings report from the previous week. But the main thing that we look at when we look at tech is the earning trends relative to the overall market. And when the earning trends for tech is stronger than the overall market, it tends to outperform, going forward. So as we look at the trends right now, we have not seen any break. The technology sector earnings relative to the broad-based market just made a new fresh high. And if the economy is cooling, we expect that likely will continue.
So if that's the scenario on the earnings, Keith, then it must follow that on these sort of dips, you look at all of the chip stocks, you look at Nvidia, it's a little bit lower this morning, that it is a natural incrementally buy the dip on a scaled basis, on an incremental basis, you just add on these dips?
Yeah, I think it's scaling because at this point, it's premature to say that this pullback that started yesterday is done. We're not seeing on most of our metrics now, unlike early August when we upgraded the sector, it had the worst 1 month underperformance since 2002. We're not in an oversold condition yet. So the way we think about it is we think the primary trend is still positive. You maybe have to go a bit lower first. So scale into it, not trying to be a hero calling the exact bottom, but saying, hey, do we think the AI cycle has further to go? And as we get deeper into the fall, I think there'll be more discussions turning back to AI, meaning Apple will come out with their new iPhone. I also think, there will likely be a PC upgrade cycle. I don't know about you all, but the PC I have at home is about 8 or 9 years old, waiting for some of this new technology to be moved in there. I think you're going to see that as well. And again, if you're going into a slowing economy, companies are going to need to continue to invest in technology, otherwise be left behind.
Fair enough. And Keith, even though tech sold out, everything sold off yesterday. You had Russell 2000 fall by some 3%. An equal weighted measure of the index fell just by 1%. You had some of the defensive plays do better yesterday. Real estate, a bond proxy, did better. The staples, they gained yesterday. Utilities fell by only 0.1%. So even though I understand you're overweight tech and you see some promise there, do you see a shift in the market leadership where it's not just tech that is rising?
Yeah, I think at least short term, you're certainly seeing, even the last month, if you look at the market, the S&P was up last month, but is really led by the defensives. You see the 10-year Treasury yield coming down. So the tone of the market on a short-term basis has changed. And I think that's reflective of this growth scare. And the reality is this, whether the economy is slowing down or, let's say, something more sinister like a recession, the transition is sloppy and it feels weak. So it's not, abnormal to see this kind of transition. Our base case is that we're not going into recession. So we think we'll have this growth scare. And then as we get out of this growth scare later this year, as the Fed starts moving or cutting rates, that we'll see a rotation back. But I think in the short term, I think it's likely to continue. The other thing, I think perspective is helpful. We were up 9 of the last 10 months. And we look back historically since the 1950s. Following that, after being up 9 of 10 months, the next month is only up 33% of the time. So we already know everyone's talking about September, the seasonal headwinds, but we know September and then into the election, as far as September and October. October tends to see a spike in volatility as well. So it's likely going to be, sloppy here for several weeks, maybe a few months into the elections.
It's a nice way to refer to it, a sloppy transition. Commodities are having more than a sloppy transition. They're having a brutal sell-off. In that sloppy transition, what's the outlook for the commodity side of the equation?
Yeah. So, I mean, listen, commodities have been under pressure for several different reasons. One is more supply coming online, but also the global growth numbers, I mean, from China. And then you all talked about this earlier, the weak ISM number. I will say, though, I mean, the ISM manufacturing gauge has not been that great as far as predicting the economy. It's been sub 50 for 21 out of the last 22 months. But all in all, you are seeing just things that are cooling. And I think that's what you're seeing in oil. I will still say, as you're getting closer to the election, having a small position in commodities or oil, I think still makes sense because there's still a lot of political uncertainty. And typically those things happen, they're very acute. They happen in 1 or 2 days. So having a small position, especially as $69 and change on crude oil, I think makes sense.
Okay, Keith, thank you so much. We get ready for a little bit more of the sloppy transition. Keith Lerner there of Truist, his calls on the markets. Coming up, Nvidia shares off the session lows ahead of the market open. We dig into the chip maker narrative with Dan Ives from Wedbush. Context matters on Bloomberg. It's Bloomberg Brief. I'm Manus Krenning alongside Danny Berger here in New York. Stock in Nvidia still firmly in the red, pre-market trading. That's after a double whammy of a historic right and a subpoena from the U.S. Justice Department. Joining us now is Dan Ives, Senior Equity Analyst over at Wedbush Securities. Dan, you're on a tour. You're in Asia at the moment. We know that. We'll come to that in a moment. Stock down 9.5% yesterday, lighter on its feet this morning. $278 billion of a wipeout. Why? What was the trigger, or was it just some kind of an August redux?
Yeah, look, I think there's just fears in terms of growth, not just from Nvidia, but I think across semis, and that's why you just saw a disaster day, for just the whole semi food chain. But I just look at it, has anything changed? And look, that's why we're in Asia the next few weeks. Nothing's changed from a demand perspective. Demand continues to way outstrip supply. And then you look at earnings, I think it was sort of a muted reaction. But I think we take a step back, and this is a story where the demand continues to ramp up from an AI perspective. Blackout delays, put to rest. I think these sell-offs, in my opinion, are buying opportunities, not the time to panic.
I just wonder, Dan, if an antitrust probe, if that escalating from the DOJ, this subpoena, if it hits your registry of concern at all for Nvidia?
Yeah, look, I think you have to put in the context of broader tech. I mean, Apple, of course, Google, we'll have another trial next week. I mean, that is just sort of the tone in the Beltway. I mean, we are just going to see some of those drum rolls. Look, we're not too concerned about this for Nvidia. I think just because when you actually look at what's happened here, from an execution, the reason that they've essentially dominated it is just because how stellar the execution has been and how they've just been so far ahead. AMD and others will ultimately get into this sort of race, but I just view this as more of a scarier headline than the reality. And also in the context of what's happened in big tech, Nvidia is just part of the club that continues to be part of that pressure, Beltway versus big tech.
Part of the accusation is that it's harder for suppliers to switch. It penalizes buyers. What is the worst case scenario here? Is it a chip, a mini chip or fissure in the moat, the grand moat around Nvidia?
Look, the moat is what Jensen and Nvidia have created, right? I mean, and that's not going to change. And I can almost take the other side. Okay, DOJ is looking into this. Rather look into this, give some sort of all clear so it's not a concern. I mean, look what we've dealt with the likes of Apple, Google, Amazon, some others for a number of years. But I don't think it changes that. And I think the reality is they are the only game in town. And nothing's changing that. From an innovation perspective, when you talk about $1 trillion of AI CapEx over the coming years, where Nvidia is going to get a significant piece of that.
In just this political climate, though, Dan, where you have two candidates and their vice presidents who almost feel like it's a competition of who can have the most populist policies. And then you look at something like Google getting slapped for antitrust violations, too. is this a political climate that maybe you need to take a second look at some of these big tech names that we thought were safe from antitrust regulation and scrutiny, and maybe this time is different?
Yeah, look, I think it is a little different. I mean, look, Apple, we'll see that over the next, call it 12 to 18 months. But I think after that Google win from the DOJ, I think the climate does change a bit. But I think the reality, look, we've talked about it on the show, strong have gotten stronger. I mean, you talk with your previous guys about Mag 7 and big tech. That's not going to change. In other words, big tech are going to get stronger. And I'd argue with AI revolution, that's actually accelerates. And we'll see next week, when Apple launches the iPhone 16. So to me, it is changing of the climate, but I think it just speaks to just tech is just going to become a bigger and bigger piece. And big tech, even through M&A, I think that's going to be the biggest variable. FTC Con, where that all goes depending on political climate. I think it's all added to some of the agita as once September hits, going into the elections. I think that's also some of the sell-off that we've seen, just some of the nervousness going into the fall.
Well, Dan, you're in Asia at the moment. Part of that trip will involve, I presume, seeing people that feed into this supply chain. Two things I want to know about is how do they see demand holding up? You got the iPhone launch coming up. And secondly, how much conversation are they having around the political change here, the risk of new tariffs towards Asia?
Yeah, great questions. I mean, look, one, the reason, there's a second trip to Asia in the last month, got to see where demand is, right? I mean, you're not going to find it in the spreadsheets or 10th floor of a New York City office building. But from an iPhone perspective, I mean, units, iPhone 16 originally started 84 million. It's above 90 million. And that's bullish in terms of what we believe supply chain's indicating in terms of what will be an AI-driven super cycle with iPhone 16. And I still believe an underestimated demand cycle that's going to play out for Apple. But then, you talk about just broader demand. Demand continues to tick up, not tick down. And I think the tariffs and some of the U.S.-China cold tech war, that is a worry. And I think that's the probably biggest question from investors that we meet in terms of going to November. What does each candidate mean in terms of, the quote-unquote AI trade in terms of Trump or Harris?
Are the companies taking actions now, Dan, to try to protect themselves in that case, or are they waiting to see the result of November?
I think it's results. And look, the reality is there's a limited amount they can do because of just where just the vast majority is coming out of, China and coming out of Taiwan, coming out of the region. And that's not going to change overnight. But, to what I think we saw with the sell-off, it just speaks to some of the broader worries. Nothing's changed fundamentally.
Yeah.
We continue to think valuation, these tech names, numbers will continue to move higher. But it's some of these white knuckles going into September, going into the election, that I think you're seeing, some of the softness in big tech. But I don't view it as anything more than that. I think a lot of these names continue to move higher into year-end 2025. Despite, obviously, I'll call it a white knuckle or an agita period.
Look, we know you're an evangelist of Nvidia, Jensen Huang. We understand that position. Do I now need to look at my investment in Nvidia as two portions? One is a long-term investment, and the other portion of my participation in investment is trade. 10% swings, 5% swings. It's split in two now.
No doubt. Look, we've said you're going to have to put seatbelt on in tech. I mean, this is not going to be a smooth ride. How it's going to be coming on, saying turbulence, put on the seatbelts. Okay, so the point is we are going to see that. And I think you have to be ready. But also that creates the opportunity as well. Just like we saw on Black Monday in Tokyo and what we saw yesterday and potentially over the coming weeks, that creates the opportunities. But there will be volatility. But I think in the end, they're growth scares. And I think we look at these as more opportunities rather than the structural change, as many of the bears are coming out of hibernation mode.
Dan, before we go, got to ask, do hotel rooms in South Korea come with their own Penn State Nittany Lion swag?
They do, especially after just that domination in week one. It's surprising what you see. I think Big Ten is starting to become global.
It's a global phenomenon, as are you. Dan Ives, thanks so much for joining us. Dan Ives of Wedbush Securities. Okay, a quick market check. You are looking at two-year yields continuing to move lower, trading at about the lowest so far of the year. NASDAQ under pressure, as is NYMEX crude, down about 0.2% after falling yesterday. Some big losses. Let's bring in Bloomberg's Will Kennedy on this, the executive editor for commodities. Will, why the tantrum in oil yesterday?
I think it's a combination of several things. The immediate catalyst was an interview that actually Bloomberg did with the Libya central bank governor, which suggested that a solution to the problems that we've seen in that North African oil producer may be closer at hand than people expected, potentially bringing 500,000 barrels of oil a day back to the market. And then you combine that with a realization as people got to their desks after the summer holidays that OPEC was indeed likely to proceed with an increase in production, and continuing worries about the strength of the Chinese economy. You put all that together and it turned out to be a pretty bearish brew. We saw quite a lot of trading both on futures and options, and yes, quite a sell-off.
How would you describe, well, good morning, how would you describe the physical market in terms of the draws, the drawdown in the physical market? Because that's going to be what OPEC Plus are focused on, isn't it?
Yes, and I think the picture that we've seen is that the physical market has, as many people expected, looked fairly tight over the summer months, that probably global inventories have been drawing down, that demand has been very good as people travelled, they drove on holiday, they flew on holiday, but there's an increasing expectation that that will wane a little bit as we get into the last third of the year, that we will see this extra OPEC crude in the fourth quarter, that we are facing a very weak Chinese economy, and you put that together and I think that people are expecting inventories to build perhaps at a faster pace than they did. And then you add to the fact that most forecasts for 2025 really do look like we may be facing a period of supply, and that's what's fed into this situation.
Well, the oil market's having its very own taper tantrum, that's for sure, as soon as that OPEC supply comes back. Well, thank you very much. Will Kennedy there on the oil markets. Coming up, awaiting more data and more of a guidance on the rate path. Context matters on Bloomberg. Good morning from New York.
You're watching Bloomberg Brief. Danny Berger and Manus Cranny in New York. Let's get you set up for your trading day on this Wednesday. We're going to get some retail earnings before the bell, including Dollar Tree and Dick's Sporting Goods, plus more economic data. Jolts will hit, a little taste of jobs to come. Factory and durable goods, those come out at 10 a.m. Eastern. And then we'll get the beige book from the Fed, Manus. That comes out at 2 p.m.
A couple of individual movers to keep an eye on, Danny. We're counting down to the market open on Nvidia. We bounced off the lows. We were down 1%. But certainly what you got is a taper tantrum in the oil market. Risk off took money into the bond market yesterday. S&P down by 0.3%. This is the worst start, by the way, for some of the tech stocks since 2002.
Yeah, and it's this head scratcher of why the drop in Nvidia. Why the huge sell-off across markets? It wasn't just tech, to be clear. It was also Russell 2000 that fell some 3%. It feels like this is just a nervous market. As Keith Lerner of Truist put it, it is a sloppy transition. And you kind of see with each little piece of data, those nerves kick in.
Yeah, I mean, that's a nice way to describe it. A sloppy transition. It's not done yet. There's a sense, I mean, Dan Ives was with us, and there was a real sort of sense of just stand back for the moment from Dan Ives, rather than that usual full bull evangelization of Jensen Huang. The mood is, it's not completely oversold, but you just got to be cautious as far as this market is concerned.
Yep, certainly caution, the name of the game. That's it for Bloomberg Brief Surveillance. We'll take things from here.